All right, here we are. Welcome, everybody. Thank you. There we go. We got it right out of the way. Uh, Thanks, everybody, for joining us. This is the second part of our webinar series on aggregators. The first was how the aggregator landscape is changing for good. This one today is titled Growth Secrets from Top Brand Aggregators. And the point of these talks, amid all of the news that we hear about the aggregator market and the market in general, is to really talk about the good things that are trickling down from this ecosystem to individual sellers. So without further ado, we're going to jump right in. I have a fantastic group of people joining me today. I'm really excited for this conversation. We're going to get a little bit deep into some of the tips and tricks. I should mention, my name is Eric Davidek. I'm with Sellers Funding. Sellers Funding, if you don't know, is an e-com lending partner. We offer growth capital solutions. We have transparent funding options that span the gamut from just working capital, so funds in your pocket, to daily advance. We can advance yesterday's sales on Amazon and all other marketplaces. We have a digital wallet, all that kind of stuff. Basically, we try to keep cash in hand so you can grow, take advantage of opportunities. Again, I'm joined by some fantastic aggregator representatives here. I'll let them introduce themselves. Let's start out with Corian.
Awesome, thank you, Eric. So my name is Corian Morris. I am the Director of Growth at Unibrands. So essentially, I support our acquisitions function. And for those of you that aren't familiar, Unibrands is a strategic acquirer of Amazon and direct consumer brands.
Fantastic, thank you. And Walter, if you wouldn't mind.
My name's Walter Gonzalez. I'm the founder and president of Goja. And while we get called an aggregator, we've been operating for almost 14 years. So we're kind of an operator aggregator.
Awesome. Matthew.
Hi, I'm Matthew Boyter. I'm a director on the M&A team at Elevate Brands. And we are operators first. I mean, we run by e-commerce founders and entrepreneurs. We understand what it's like to build and run an e-commerce business. And we partner with sellers to help them grow and scale their brand.
Thanks so much. And Joe, go ahead.
Hey, I'm Joe Lambergiva. I am the head of Amazon at the mothership. We buy and scale e-commerce businesses into more lovable and sustainable brands.
Awesome. And Mike, round us out.
Hi, everyone. I'm here in place of Aram, but I work on our team as an acquisitions manager for a company called Intrinsic. We buy and grow e-commerce brands in the health and wellness space. Thanks.
Awesome. Thanks all. Well, hey, let's jump right in on this first one. We'll follow the same answer pattern here. So starting with Corian. First question I have is just in general, it's a bit of a softball, but what tools, tech, podcasts, trends, what's kind of on your radar right now? Where are you learning new things?
Yeah, absolutely. So, there's kind of two sides of the house for Unibrands. We've obviously have our acquisitions function and our commercial function, which really operates the brands that we own. One tool that I think has been pretty valuable in our pre-LOI due diligence is the data dive tool that Brandon Young has put together. And then for me, as somebody who is relatively new to the M&A space, I was an operator, exited a brand in the past. Learning about M&A has been really interesting as well. And so there's a podcast that I've listened to by Kisan Patel, and it's called M&A Science, and just dives into M&A, whether it's in the aggregation space, whether it's in corporate development, just to learn kind of more tips and tricks to make me a little bit more effective at the job.
Awesome. Walter, how about you?
So as a business, we're a very SKU focused business versus like a brand or a portfolio. We're very, very SKU focused. So all the tools, many of the tools we built over the years, because we've been around for so long, we invested in a technology team a long time ago. And so to that theme of SKU focus, our tools are, whether we buy them or we've built them, are at the SKU level and as granular as the data is available. So if it's available at an hourly basis, we'll do it on an hourly basis. But so to that theme though, I read the book. I listened to it to be fair. I listened to The Goal, and it's a book that Jeff Bezos makes all his executives read. And I've given, everybody in the company has read it, and I've given it to many friends, because something that did happen to us over this fast growth M&A story was you start to focus on little pieces of the business as opposed to the whole, and then you realize you made less profit even though you did more revenue or you did more X. And this kind of was a good book for me to kind of for myself and for everybody to say the purpose here is not to make a piece of the business better, it's to make the whole business better and to deliver profit. And to us, it's at a very SKU level profit. So to me, that book really resonated. And it's not a technical book, it's a really interesting story. So I understand now why Jeff Bezos recommends it.
Interesting. And yeah, I think listening absolutely counts.
Fair. But I can't say I read it anymore. So when I tell my daughter to read a book, anyway.
Matt, go ahead.
Yeah, so I mean, data is king. And at the moment, there's so much data available from Amazon, but trying to get that cut through and understand what the data means and have actionable points, that's what's really key. So, I mean, similar to what Corian mentioned, I mean, Brandon Young's Data Dive tool really helps you get some key, understanding of the keyword trends, across your ASIN and, across the market. So that's super helpful. I mean, Amazon's starting to publish a lot more data. I mean, their product opportunity explorer is giving, a lot of data analytics, and, that's really helpful if you can build out ways to, interpret that better. I mean, from an accounting perspective, I mean, when the sellers use a tool like A2X, that really helps, present the financial statements in a way that's easy to understand.
Yeah, fantastic. And Joe, what are you interested in?
I will throw my hat again for Brandon Young's Data Dive. It's fantastic. Our team started using it and really changed the game. I think I would definitely tune up on the analytics point. So I've seen a couple of tools that are really, really good in terms of understanding what's happening with the market, with your category, with competition. One has a bigger price tag, and that is Django Scout Cobalt, which gives you like a really good understanding of what's going on. The second, more affordable version, I kind of the toned down, but still very good, is the Helium 10 360 market reports, which I think, sellers should definitely check out. I think from just getting really fresh and new ideas in terms of what you should do strategically, in terms of business, I really have enjoyed our team joining the Inner Circle Masterminds and all the content that it comes out there, because I think there is so much wealth that sellers can essentially offer to support other sellers, as well as Kevin King's $1 Billion Seller Summit. I think this one is really excellent. In terms of additional sort of sources of inspiration, I found DALL-E, which is a pretty cool new AI piece of, software website. Really interesting, because I think it's going to change a lot about how we think about creative and how we get inspiration in terms of what we're going to also even put from just an Amazon point of view in terms of our heroes cues. And actually, a lot of data is coming from TikTok. So I would definitely encourage sellers to really watch that space in terms of inspo.
Nice. Thanks. And Mike, how about you?
Yeah, I mean, I think that most people who are selling, at least on Amazon, and everyone else in the panel has explained a number of the tools that we use. Data Dive is obviously one that everyone's calling out. Helium 10, Jungle Scout, Smart Scout is another one that we use as well. More recently, and this actually just started out with like me getting an email newsletter every week or so, called Exploding Topics. This is now one that we've signed up for the pro level, to just see which sort of keywords are trending on Google search, etc. And it helps us see like where potential things might be fads or what might be, around to stay.
Yeah, awesome. That is a good newsletter. I get that as well. It always makes you think like, oh man, there's so many things I should be investing in, so many things I should be doing right now. It also sounds like we should get Brandon Young in here to sponsor this thing. bit of free advertising here for Data Dive, but it is a fantastic tool. All right, thanks everybody. So we're gonna get a little more in depth here and maybe challenge you guys a little bit, and I'm gonna shake up the order. So my second question I have is, aggregators in general. What has been hype? What's been real? What should people really be thinking about this space right now? We'll go to Matt first on this one.
Yeah, so I think the hype was you can acquire multiple brands, obtain many synergies, and take advantage of the multiple arbitrage between what you pay for the brand versus what the aggregators are valued at. However, bolting in these businesses, it's a lot more complicated and there's a lot more nuances. It's not easy to manage supply chain across 50 or 100 brands. It's not easy to manage so many different seller central accounts and keep the wheels running. I think what was real is some groups have managed to navigate this better than others. And Elevate Brands, despite the tough market conditions, we've managed to achieve 17% year-to-date, year-over-year organic growth, which is due to us not biting off more than we can chew. And we are operators first. So we managed to achieve some of the synergies that we anticipated.
Awesome. How about you, Joanna?
I think there's definitely hype in terms of what a good business is. I think there was definitely the gold rush where a lot of businesses on Amazon were purchased because perhaps very punchy revenue numbers, but actually there was not the question about, is this actually a sustainable long-term growth business? Does this product have unique selling points? Is it commoditized or not? So I feel like there was a lot of mad rush to buy as much as possible volume and not so much consideration about, is this really thinking for the future? So I think a lot of aggregators, a lot of the space made the mistake of trying to gain volume without understanding whether there is a core value in each and every business. That said, I think there is absolutely a huge opportunity for businesses who have indeed a solid brand. I would actually just call it a brand. Basically, businesses that have built their foundations in such a way that customers really clearly see their unique selling points. They clearly see like what their potential is. And I think when you pair that with aggregators who understand the space, who understand each and every entrepreneurs and every brand's sort of unique opportunities, and pair them up with a superior logistics system, with superior marketing strategy, I think there is indeed a stellar opportunity for growth.
Yeah, good perspective. Walter, speaking of perspective, you've got kind of a longer perspective than everybody else here, Frank. What do you think has been hype? What's been real?
So aggregation or inorganic growth is a means to an end, right? So what is the end? If the end was defined as aggregating as much as possible, yeah, I think it was hype, and I think it's going to be extremely tough if that was the strategy. If the end was a sustainable, profitable growth, be it at the brand level, at the SKU level, or whatever, however else, then I think aggregation is another means to the end, right? So we've built brands, we've launched SKUs, we've acquired SKUs, we've acquired brands, and then we've launched SKUs and acquired brands, and it's a lot of it is the same. It's a piece of the story of what you're doing, right? So if you've acquired it, then you didn't have to launch it, or if you launch it, then you might need some other things, but it's a playbook that we've had for a long time, and so I think the hype was around how fast and how big you could do this, but I don't think the hype is anywhere around. The hype is not around how big I think and how important an Amazon story is, and how valuable it is into how brands will get built, how product will get built, how how this e-com story gets played out. I think Amazon is just central to it. So half of it was hype. The other part, I think it's as real as ever.
Yeah. Mike, how about you?
Yeah, I mean, I feel like a bit of a broken record here, but I think that, thinking that you can buy a million companies and generate synergies is a lot easier said than done, especially depending on the teams that you go after. It's not really just like financial engineering. These are actual brands that have to be operated. So investing in those operators after they're acquired is extremely important. You're not just going to generate synergies. Like if your KPI for the business is number of acquisitions, it's not going to be a success story. And so it sounds like a lot of people, everyone on this call is saying the right things. Like, you have to invest smart. You have to operate these businesses the smart way. And there are opportunities to continue to grow them going forward, but just doing acquisitions without, you know, planning for the future is not going to work, and that's where a lot of the hype came from.
And round us out, Corian. Where do you see hype in this ecosystem?
Absolutely. I don't know that I have anything that new to add here. I mean, I would generally agree. I think there obviously was a tremendous amount of hype last year. I think, you know, part of the hype was this assumption that you could not retain founders or founding teams and just, you know, build a model and continue to operate brands and see the growth that, you know, the founders were experiencing. As somebody that was an operator, I could attest that wasn't the case. Like, it's pretty difficult to operate an Amazon brand. And so I think that's one thing that served us incredibly well at Unibrands was, you know, we've been very methodical kind of from day one of, you know, understanding what do we actually have the skill set to acquire and operate effectively, and only taking that on. And then also in instances actually retaining the founding team, which has helped us out. And so, you know, as far as what's real, I think it's the opportunity, right? Like the ability to actually go out and acquire world-class micro brands to effectively scale and operate those brands across different platforms. I think that's incredibly exciting, but it's a lot easier said than it is done.
Yeah. I think, you know, it's been interesting having conversations with so many aggregators in the space. And as time has gone on, it seems like those who are really hyper-focused on, you know, their niche and what they're doing, and that kind of are doing that at their own pace, seem to be the ones who aren't really affected as much by what's happening out there. I think probably everybody here on this call would fall into that category, which why you guys are still here, I suppose. So I've got a question here about some of the immediate challenges. I think we talked a bit about that with that last answer. If there's anybody that wants to hop in there that maybe has anything to add or that's slightly different that we didn't get to there, as far as the, you know, what challenges face aggregators specifically right now, and where maybe are the opportunities in that? And I'll just open this one up. Does anybody want to jump in on that?
I think.
Oh, go ahead.
No, go ahead.
Go ahead, Mike.
I was just going to say that, like, Amazon itself is a major challenge in the space. I think that most sellers can see, and we've seen it as owners of brands, the costs are constantly rising there, especially on the FBA side. The marketing side is also rising. And I think that Amazon in the past has taken more of a position where it's customer first, and they don't really look out for the brands that sell on the platform. So, you know, if you have an ASIN that goes down for whatever reason, whether it be a bad actor or one of their bots catches it for something that doesn't necessarily make sense, could be days to weeks before you get it relisted. So I think that moving beyond just Amazon as you look to build the brand is something really important. At least here internally, we say, you know, Amazon's a good place to start a brand, but it's not a good place for a brand to grow old. And I think that that's definitely true, especially with the rising cost environments of just operating on Amazon and the immense amount of competition as well. Yeah,
it's a tricky marketplace. Walter, you were going to hop in there too.
I think the challenge that a lot of people have come to understand is, you know, the small businesses on Amazon are hyper efficient, and this thesis that you could buy a bunch of hyper efficient businesses and make them even more efficient is a tough one, right? And so that's what's fed. I mean, we've learned, we kind of knew that, and then we made some acquisitions that kind of ignored what we already knew, and so we kind of had to go back to that basic. And so the question is, you know, when you acquire these brands, can you keep that efficiency? And so for a long time, we've modeled our business competing with China, which is really efficient. And how do you act that way? And I think going to the future, to Michael's point, I mean, it's a very competitive landscape that looks a lot more like trading stocks than it does like selling products. And how do you keep that efficiency is what we talk about, which is why, you know, a lot of what we do is just how do you pay uber focused attention to SKUs. Even branding takes a second seat to the SKU, right? So it's so different for me, and it surprises people that come to our business when they say, wow, that has nothing to do with the way when we used to sell product to Walmart or to CVS or whatever. It's just so hyper focused on on very efficient SKU level performance. And that means, like, you know, for example, you know, do you buy full container loads? You know, do you focus on 10 SKUs that have that potential to grow versus, you know, 50 SKUs, and do you even build branding? It's just such different questions. So I think those challenges are becoming very apparent now, which I think may have not been apparent on you know, before.
Interesting. Any other challenges, opportunities worth noting?
I think from I will take it a little bit more macro, which is the inflation is a massive problem for, I think, for all of us in the room. Obviously, the more basically the more the consumer prices increase, and all prices increase, like our logistics costs increase, that's for everyone. Our margins get squeezed because it's not so, as everyone knows, it's not so easy to increase your price on Amazon. And obviously, on the other side, consumers are getting more and more nervous about their spend. So therefore, even prices get even more of a tricky topic. I think in terms of opportunity, that is also kind of where you offset some of the opportunity in terms of brand and brand collateral, in terms of like what, like essentially how you invest your money into like the right product, and the USPs that you like, the unique sort of quality points, I would say, that the customer perceives in that product are even more important. So yeah, I think these are definitely two huge challenges. And there's obviously, like, from the just the aggregator point of view, everybody knows that it's become much more difficult to raise capital, which of course makes it more challenging for us to set our targets, which makes it more challenging for us to set the right or like very ambitious offers for our sellers. So, you know, it's a challenging time, I think, all around.
Yeah, lots of trickle down. Matthew, I'll give you the floor. Anything?
Yeah, just to elaborate on what Joe said there, I mean, the capital markets are a lot tougher this year. I mean, billions of dollars were raised last year, and that same level of investment isn't being seen this year. So some aggregators are subscale. I mean, if you don't have enough revenue, you can't really afford to have enough of an operating team to handle it. So I think there's quite a few people. I mean, there's over 150 aggregators last year. I think there's quite a few of them that are in a position where they're just not big enough to survive. So that's something that'll be interesting to see how, you know, they handle, you know, the tough economic conditions over the next 6 months. I mean, consumer spending is down, you know, revenue is down, and margins are tightening. But at the same time, it creates an opportunity. I mean, capital markets are cyclical. And if you look what happened, you know, pre-2008 and with COVID, there was a huge snapback. I mean, there is a lot of money, you know, sitting on the side. And when it does return, I mean, the multiples we are paying for the businesses are starting to drop. So it does create the opportunity that, you know, good brands do become available.
Yeah. Okay.
And I'll jump in real quick. You know, I would say obviously the macroeconomic climate is a challenge. I was just at an event with, you know, about 200 kind of world-class sellers, and everybody is challenged right now. And so for us on the buy side of the business, we're not seeing as many assets that we're maybe historically would have been really excited about that we would have seen 12 months ago. And so that's been a challenge. But I think the counter to that is it's also a really great time to focus more on the value out of your business to differentiate yourself. If you can do well in this kind of climate, I think two things can happen. One, that gets somebody like us who's still actively acquiring, really excited about your asset. And you know, you may not see the exact same multiple that you saw a year ago, but you'll still see an aggressive multiple because, you know, you're a unicorn. There's not a ton of businesses that look like yours today. But the other thing is, you know, I think if you can establish yourself and do well in a downturn, that better positions you in the future as well, which is something that's really exciting also.
Awesome. And that leads right into my next question, which I'll try to ask quickly before the garbage truck in my neighborhood comes by. And it's the beauty of, you know, live webinars. We were talking beforehand that my cat might, you know, go back and forth behind me, but I didn't anticipate the garbage truck. So this one, I'm going to go to Joe first. As far as, you know, Corian mentioned, and actually a couple of you, I think you might have mentioned as well, you know, the challenge of acquiring right now. You know, how do you position yourselves as buyers? You know, when you see a company that fits your ICP, that seems to be a good match. How do you sell yourselves at this point?
Yeah, I think in terms of our approach, we look at not just the Amazon space, we very much look at the wider e-commerce space. So we acquire both e-commerce, but both D2C and Amazon businesses. And that has allowed us to essentially invest in a very strong D2C capability. So the way we approach any business is not to talk about that we're going to grow your Amazon business or we're going to grow your D2C business, but we're going to grow your business where the customer opportunity is. So we look at the overall business on a macro level, and we look at how we can grow it in the best possible way, regardless of the channel. I think the second layer to that is, and I think that it can be underestimated, the desire for consumers to invest in more sustainable goods. And that is something that it's definitely at the core of what we do. We look at investing and making every acquisition more sustainable. And this is really important for us as a team, as a core, as a mission. And I think from like long-term point of view as well, I think buyers understand as well the importance to consumer and how this is going to return in the long term as well.
So I think you're on mute, Eric.
Darn garbage truck got me. Man, why should somebody sell to you guys? Why should somebody consider Elevate?
So, I mean, first and foremost, we are operators. Our founders started on Amazon in 2016. You know, that first proved the concept. We built, you know, brands in-house. We've launched brands from scratch, you know, and that's what really helps separate us. I mean, we understand the seller's perspective. We understand what it's like to build a brand. We understand the challenges that sellers are going through. And we try to work out structure around that to partner with them to grow their business. I mean, it takes a certain skill set to build $1 million brand. And it's a different skill set to build a $10 million brand or $100 million brand. And each people run to different challenges, you know, and that's what we really focus on. You know, we'll try identify businesses that we can add value to and see where do we have complementary skill sets. And we help partner with sellers to, you know, alleviate their risk. I mean, a lot of people are running successful businesses, but they're not taking a lot of cash off the table. You know, if your business is growing, everything you earn, you've got to reinvest into inventory, and it becomes quite risky. I mean, if it's the first business they built, you know, we help the sellers take some cash off the table at close, and then we partner with them to grow it. I mean, we'll try talk to them and see what are they doing, what's taking up the most of their time. You know, typically it's, you know, accounting, supply chain management, inventory forecasting. We'll take that off the seller's plate, and that frees them up to focus on the bigger picture, you know, product development, and getting the brand product into, you know, into different channels. And we've really had great success, you know, growing the brands exponentially after closing when we partner with the sellers.
And Corian, how about you guys? Why Uni?
Sorry, Eric, I think you're on mute, but I'm assuming you're asking me to go. Yeah, so I think there's a few things that differentiate us. I think, you know, at our core, we're about as seller-centric as you can be. So our CEO, Ulrich, spent, you know, over 20 years at Goldman Sachs facilitating M&A transactions. And, you know, one of the things that he always felt like was that the sell side oftentimes didn't have the same level of expertise or knowledge that the buy side had. And so that really informed how we built Unibrands, where, you know, we built it to be fast, fair, and reliable. We really lean very heavily on understanding what's important to the founder. Are they interested in being involved post-exit? Do they not want to be involved? They want to hang out on the beach? And we use that to inform, you know, the offer that we make, our transaction structure, which led to, you know, a cohort of deals that we did a year ago where, you know, we had a team of founders stay on board, and that's been tremendous value add for us. It's been great for them because they've been able to be a part of kind of Unibrands and our growth as well. And they've been able to have continued influence in the company while also seeing their baby that they built grow into something special. And so for us, I think, you know, the root of everything is it's about the relationships that we build, whether it's in the seller communities, whether it's with the individual sellers, of understanding what's important to them, what are their motivations. And then I think, you know, the second part of that is, again, I alluded to this a little bit earlier, but we've been, you know, very disciplined in what we go out and what we acquire. So we're not looking to, be the first company to $1 billion in revenue, for example. We want to go out, identify what fits our criteria, acquire that, demonstrate that we can consistently grow brands along that, and then, add a little bit more on. And so we're not necessarily the most flashy, but we've been very disciplined, and that's worked out so well for us.
Awesome. Mike, where's Intrinsic shine?
Yeah, so I think our mission is a bit differentiated, which helps. But we're health and wellness focused, and so we want to get health and wellness products to as many consumers as possible, and we're really trying to make a positive impact on their lives. And so that's like first and foremost what we're looking to do. And so we're trying to find brands that we think can impact consumers positively, and we can grow across a variety of different ways, in the ways that we think that we can reach as many customers and consumers as possible. And so whether that be taking it off Amazon, if it's an Amazon only brand to start, or if it's off Amazon to start, we want to try finding different opportunities for consumers to be able to access it, because most of the products for these brands that we acquire are ones that we think can potentially benefit certain conditions that maybe a doctor can't help with, or what's out there from a prescription side isn't necessarily working. And so on top of that, we have like really strong relationships with off Amazon channels, so we can grow these brands in the right way, whether it be through healthcare, brick and mortar, etc. We've really invested a lot of time and effort into those relationships to grow brands that way. And I'd say on top of it, just when we try to structure deals, this is more from the financial side of things. Like we've had a very good track record of paying deferred compensation. So if there's an earnout portion, or like a stability type payment, we try and make these benchmarks achievable. So we're actually paying founders, which we've heard in the past it's not always the case.
Nice. And Walter, what goes you?
I mean, again, it was funny to be called an aggregator one day. We've just been operating and selling brands, selling on Amazon for almost 14 years now. So I think that's a difference from a mindset. But I think a lot of the people on this call they're probably here because they're probably operators. As I start to think through some distinctions, we've just tried to make it easy. We haven't had earnouts, we haven't had things like that. I think those are the things that start to complicate things. I happen to be a lawyer, and I happen to be a former lawyer, at least in my previous life. And I just saw how messy things can get. And so just from a philosophy, one of the things that I think I decided a long time ago was, there might be an upside, but can we get to a number that makes it super clean? So there's not a lot of calculating, did this dollar happen, or if this didn't sell, whose fault was it? I found that to be in the beginning, to be a little bit, maybe the word was unfair to people that were selling a brand. You kind of want to know you sold your house for X and you don't want to know anything else. To the extent they stay on, yes, that I can understand why a structure different than that would work. But for us, we have not had somebody stay on yet. The people that we've resonated with the most seem to have been sellers, and that was at all sizes, who have said, I've put in a lot of time. I want to go sit on a beach, and we happen to be somebody that could facilitate that mission, and so they went to go sit on a beach. So I think that might be one thing that has worked for us, is just to be really simple about the structure with not a lot of caveats, and that's worked.
Interesting seeing the different approaches there. And while we're talking about that, we've got a question in the chat here. I'll read it verbatim, and feel free to jump in, anybody. We are seeing these macro problems trickle down into, are we seeing these macro problems trickle down into acquisition prices? ? How might multiples compare year over year? That's a tough one. Anybody want to give a stab at that?
Yeah, I can jump in. Cool. I mean, the macro conditions, as the interest rates do rise, that does increase our expenses. We've got to pay a lot more on the debt, and, we can't pay more. That then reduces the multiple that we can pay. So there is quite a strong correlation. As, the outlook looks worse for the business, the multiples do decrease, and it's also based on supply and demand. If there's less people out there that are available to buy a business, there's less buyers, the price is going to be low. I mean, last year when you had, 150 aggregators bid in, the prices did go up. I mean, there's not as many people buying anymore. So we've definitely seen there has been quite a strong decrease in the multiples that are being paid for businesses at the moment. And we don't really know how that's going to shake out over the next 3 to 6 months.
Yeah, I would agree. We've definitely seen a decline in multiples from 12, 18 months ago. What I will say is, I think there's still a lot of us out there that are actively acquiring businesses. And for those businesses that actually fit our criteria, I think there's a pool of us that are still willing to pay what we would define as like a really fair multiple for those assets. But in speaking with sellers over the last several months, I think the general view is like, oh, everybody's kind of paused in acquisitions. And I want to make sure that it's clear that there's a lot of us out there that are still really actively looking to acquire your business. We're willing to pay a very fair multiple. I think a lot of us are still very well capitalized. So I want to make sure that that message makes it through as well.
Gotcha. I think it was mentioned earlier about the specialization and the differentiation in the brands that each of you seek. We've talked a bit about the different ways that you buy those brands, whether it's keeping people on, et cetera. It strikes me, because I do see both sides of the coin now, working with individual sellers at sellers funding, helping them get cash to work, working with aggregators, on the portfolio level, lending solutions. There are still great exits to be had. I think where things are, the onus is a little more on the seller now to kind of find the right fit, do a little more research and find that buyer that really jives with what you're trying to build, whether it's the brand or the category, et cetera. I think, as mentioned, the multiples are down, but they're definitely not bottomed out. They're not insulting. I think it's just a matter of like, you won't get 6 different offers that are going to blow your head off anymore. You're going to find that one good partner and hopefully like build a partnership where you're both really happy. Does that sound fair? I see heads nod. So, okay, we'll leave that question go. All right, here we go. Okay, so this is a great one. Speaking of individual sellers,
interrupt you, but I think what that person was asking, though, maybe the impetus for that question was, should I sell my brand today or tomorrow? And that's an interesting question for me.
Yeah, go for it.
Well, I'm just saying, like, I don't know if I didn't say I knew the answer. I guess I get the question. Really is, do I sell it today and tomorrow? And so I've seen some sellers who asked us that. Do you think today is the best day to sell it? And it all comes down to the seller and what they think is going to happen in the next 6 months for their brand. There is a case for things getting worse, and there's a case for things getting better, and that really depends on the business you're in, the niche you're in, the category you're in, the level of competition. Whether some of these aggregators or any sellers are liquidating inventory at this crazy way, in a crazy way that's going to affect your business. So is it, I think I'd love that answer. Is it a good time to sell your brand, or would you hold on? And in general, my answer, if you were to ask me that, is my suspicion is to hold on for a little bit, because I do think we're, like when I hear conversations that we're having and others are having, the next 6 months to 8 months are going to be really telling. And so would we be really aggressive on an acquisition today? We probably wouldn't. And so if a friend of mine on the Amazon seller would ask me that, I would say, I'm not being as aggressive as I would have been 6 months ago, to be very fair or open, I guess. And so I'm curious how others is now the time to sell your brand.
Yeah, that's a question that I had, but let's jump in there. We'll jump around a little bit. Is now a good time to sell? Walter brings up a great point. If I have a brand, if I can identify, a good partner, do a little bit of research, maybe take advantage of some of the tools that are out there, I'll raise my hand. I help sellers all the time kind of think through the value of their brand and where they might be able to find a good growth partner if they decide to sell. Do you guys think this is a good time to sell? So Walter kind of threw the question out there. Mike, what do you think?
Yeah, I mean, it's such a hard answer or hard thing to talk about, and it's so seller dependent. Like, in my view, there's, depending on the category, there's going to be increasing amounts of competition and increasing costs. So you have to think about that with respect to, you know, the fact that multiples are down today. So it's really a matter of like what you as a seller's needs are, in terms of whether you want to see potential upside going forward, how much you're willing to take in terms of, you know, getting chips off the table today versus waiting to do that. So I can't really provide a great answer here. I would just say that like multiples are down right now, but it's really difficult to know with the way costs and competition continues to rise in this spaces like on Amazon, if they're going to rise again. So I'd say it's really seller needs and what they're looking for. And there's also different ways that they can potentially try to structure a deal where maybe they take some chips off the table today, and there's opportunities for you know, as the brand grows in the future to get paid well, you know, on the back end, or some sort of profit share, whatever it might be. There's ways to make a sale today worthwhile for tomorrow.
Joe, what do you think? If you're a seller, would you consider selling now?
I think it really, yeah, I chime in with Mike. I think it really depends on, you know, where you in terms of your stage as a seller. So recently I spoke with a lot of sellers, and a lot of the feedback is, hey, you know, I'm growing really well. My last 12 months are not reflective of what I'm going to do. I still have a lot of driving to do. And I say, yeah, go for it. I think, you know, the sellers are really right now probably in the best sort of driving seat to like take their businesses forward through a storm. That said, I would also caution sellers who are really keen to take it all the way and really not leave very much opportunity to grow. I think it's very important to always think about, you know, what is the appetite to acquire a brand in terms of growth potential. So, you know, I've seen a lot of brands coming and they have literally maxed out absolutely everything they can do, and then at that point you kind of are left with some bare bones and it's much more difficult to sell. So if you are seeing that your revenue and your profit is plateauing and you have maxed out everything, then maybe it's good time to like think about where are you as a seller. So I think it really depends. I think if you have a good business, if you have a good product with clear USPs, with good ratings, and just in general solid business, you always get a good multiple. Maybe not overhyped multiple, but a good multiple.
Corinne, your thoughts there?
No, I agree. You know, I think there's not a single kind of correct answer. I think it kind of breaks down into two different things. One is kind of what's your risk tolerance? You know, do you think this thing's going to go down even more? And then two, kind of what's the opportunity cost? You know, so for a lot of people, you know, maybe this exit is their first kind of liquidity event. Maybe, you know, real estate's going down and they'd like to, you know, kind of move over to that asset class instead. So I think the answer is going to be different for everyone. I don't know that there is a right or wrong answer. With that said, you know, again, you know, as Joe shared, if you have a quality asset, like you're still going to get a good multiple on it. And so no reason why now could be a great time to exit. But if you've got some work left to do, this could be a great time to do that work as well, and maybe pause for a while.
And Matt, I see you shaking your head.
Yeah, I mean, I agree with everyone else's comments. And just some additional qualitative factors to consider. I mean, we've seen some sellers who, you know, they're working on multiple businesses at the same time. And, you know, it's a matter of bandwidth. There is only so much time in a day. And, you know, sometimes the Amazon business isn't their main focus. And they want to sell it now so that they can focus full time on a different business or another project. And for them, you know, they just want to move on. And regardless of where the market conditions are, they just don't have the bandwidth to keep everything running. Or even, you know, personal reasons, like Walter said, some people want to go kick their feet up on a beach. Some people want to focus on their family. And that has a big impact. You know, if they want to, now's the right time just to free up some bandwidth for the next chapter of their life.
So Walter, the bad news is, you know, we've got a lot of really smart people in the room who do this all the time, just like you. And I think the consensus is like, it depends, frankly, if this is a good time or not. So
Fair.
yeah.
Fair.
I think, as Joe mentioned, though, it's interesting because it seems to be more seller driven now. It's not necessarily a seller's market, I would say, because of, you know, where the multiples are, but the decision is far less pressured now. I actually spoke with a seller last week who was right on the verge of selling last year because of the multiples, and because of, you know, watching the hype train kind of come through. They decided not to, and now they're you know, you might think, oh, they're kicking themselves now. It's the opposite. You know, they have made tremendous gains in the last year, along with everybody else in the market, and they've kind of positioned themselves to take advantage of that now and ride out this storm a little bit. So, you know, it all depends. I think that's the answer. So speaking of which, you know, we are facing some pretty heavy headwinds, as people say. You know, I'd be silly. My team's in Miami. Walter, you're down in Miami as well. It'd be silly not to note that, you know, there's an actual storm brewing as well. Fingers crossed that everybody's safe and sound from that. But, you know, this economic environment that everybody's facing right now is going to be challenging in a lot of ways. If you guys were sellers right now, you know, what are some of the things that you'd be watching? How would you be prepping yourself for what's to come? You know, what's around the corner? Let's go to Corian. What do you think about that?
Yeah, absolutely. So, you know, I think about a lot of things kind of in the context of us acquiring that brand. And so, you know, what are some things that can really help to differentiate them or provide value? I think, you know, momentum is a major one for us. Is, you know, what can they do to ensure that, you know, coming out of Q4 and into Q1, that they're continuing to drive significant momentum. I think you can have kind of a difficult trailing 12 period, but let's say if the last 3 to 6 months have done well, we can get excited if there's a story that we can kind of tell around that, and you can drive evidence around that. I think the other thing is just understanding, like, okay, the direction that we're heading from a macro perspective, you know, consumers are going to become increasingly price sensitive. And so I think, you know, the ability to differentiate your brand is that much more important when, you know, everybody's at a reduced price. And so whether that's, you know, just better storytelling or, you know, continue to build on that review mode, but find some way to really kind of differentiate your brand so that consumers feel like there's some element of loyalty to your brand, as opposed to just going out and selecting an alternative, I think are two areas that I would really spend time focusing on.
Differentiation. All right, Mike, what do you think?
Yeah, I mean, at least from a top line perspective, if that's, you know, the period of the stage that your brand is in terms of growth, if you're looking to grow top line as much as possible, then yeah, I completely agree with Corey in there. In terms of differentiation and building brand equity, you want to be able to take as much share from your category as possible, whether or not the category is growing or declining because of potentially macro reasons. Being able to increase your share of it is can be done with brand equity and product differentiation. On the flip side, if profitability is more of an issue, let's say you're earlier stage, you've been reinvesting everything or heavily investing in marketing, so your top line is still strong, but now you actually need profits because money's tighter. There are some ways that you can potentially try to optimize, whether it be on the supply chain, looking at your packaging, trying to decrease, you know, size and cost for, you know, 3PL, et cetera. And then just looking at the way that you're spending on your advertising. There's ways to optimize your returns on advertising, how you're bidding and the effectiveness there, which are all ways to improve your profits.
Awesome. I'd be remiss if I didn't mention that, you know, seller's funding might be a good option if you need some capital. Matt, what do you think about that? How would you try and shore up a brand right now?
Yeah, I think you've got to get back to the basics. I think especially going in now, it's tough on margins. I mean, container costs shot up to, you know, over $25,000 per 40 foot. And now they've dropped to, you know, around $4,000 or $5,000. So a lot of people are sitting with too much stock in the US at a higher price. And that's going to be tough on margins. I mean, often the products are a bit commoditized, and as one person gets an increase, they pass that increase on to customers. So a lot of people we've seen a lot of people are in the position where they've got to sell their products at break even or even a loss just to try and keep their market share. So I think to the extent you can get, as much, improve your margin to the extent possible. We've had good success going back to our suppliers in China and renegotiating rates. I mean, the US dollar has strength against the yuan, and the suppliers, the manufacturers also feeling the pinch. So, you can try get better prices where you can. Definitely renegotiate all your shipping costs. I mean, every week we check, they are going down. So just try and improve your margins where you can.
Yeah, makes sense. Joe, what do you think?
Yeah, I will chime in with actually quite a few of the comments here. So I would say, watch your profitability. The first thing you really need to think about is margins and how, you can optimize your logistics, your, supply chain in general to keep those stable, and to like try and reduce the pressure that obviously is coming from like pricing squeezes. I think, from like a sort of the Korean point that he made was around like customer loyalty. I think finding funnels or finding ways to ensure that returning customer keeps coming back is super essential. So I would say, like, I would get much more cautious view at this point, and I would just really focus on profitability, gaining your customer, owning your customer, getting them to return, and optimizing everything from supply chain to, even your advertising campaigns through smarter software, smarter campaigns, just be smart with your money.
Walter, anything to add here?
So for us, the last 2.5, 3 years, whatever it's been, was about top line growth, and now it is almost 100% around profitability and margins. So everything that entails. In fact, I don't even know if revenue is a target for us, put it that way. It's very much about what we used to be before the growth, which was just knowing where every penny goes and making sure it's a penny well spent.
Makes sense. So it sounds like
I would also say, by the way, on that, the process is something that when you experience fast growth, process seems to go out the window, and that is something that as the president and founder of the business, I go back to what used to work for us from a process perspective, and is that scalable, and can we keep doing that, or is there a new process? But process and profitability just are what we're looking at for the next 6 months, because I do think there's going to be a lot of really interesting opportunities next year, and I want to. We want to be sure that when those opportunities come up, we've built a scalable process, as opposed to, just stacking it again and then going through another, period of trying to figure it out. So that's our strategy for a lot.
Yeah, it's interesting. Everybody said some form of kind of getting back to basics, doing what works, making sure that, that all your bases are covered. Mike, I did like the piece that you mentioned about declining categories. I think that was you that mentioned it. Forgive me if I'm wrong, but while shoring everything up, there are those little opportunities to kind of take over some more ground. To send out, to do things a little bit different, and declining categories could be exactly one of those opportunities. Price gets a little cheaper to expand when things start to decline. So we've got a few questions coming in. I want to save some time for that. So I'm going to go ahead and jump to what will be the kind of final question here from me for you guys, and then we'll get into some of these listener questions. So the question I would ask is, in the next 3 years, we know nothing about what the economy is going to do. But hey, let's rub our crystal balls and see what we can come up with here. In the next 3 years, how do you see the aggregator ecosystem evolving? And I think more importantly, how do you think that it's going to contribute to the trickle down to individual sellers? What is the aggregator contribution going to be over these next 3 years? Let's go to Walter.
I mean, it goes back to, first of all, I believe in the aggregator story, which is you can inorganically grow a business. So I don't think that goes anywhere. So for the next 3 years, everything we've said over the last 45 minutes or so, which is build a good business, build a good brand, that can be acquired. And so it doesn't change that much for me whether we're talking about 3 years, 5 years. I still think the space has a lot of opportunity. The question is, so building a brand that is acquirable, if that's the right way to say it. We have seen some brands that just could not be acquired, or they were difficult to acquire because they had 2,000 or a lot of SKUs, for example. Given what the aggregators I think have learned, my suspicion is that a lot of them would say anything that has really high SKU count becomes really difficult. And so if your plan in 3 years is to exit a brand, what do you start doing today? I would not necessarily, I personally wouldn't, suggest getting into something that has tons of SKU count and tons of variations if that's where your revenue is coming from. I'd focus on things that are going to make it easier for aggregators to focus on, which are, more revenue in less SKUs. That's easier said than done, of course, but those are things that I think a year ago, almost anything could get bought. I think going forward, that world has changed.
Joe, what are your thoughts?
I think just from the aggregator space point of view, I'm fairly sure that what's going to happen, and I think is already kind of happening, is that there's going to be a massive consolidation. I think, some of the bigger, more successful aggregators are going to probably acquire some of the smaller or less successful aggregators who have maybe gone and acquired bad properties. So I think from that point of view, maybe the space is going to become a little bit clearer and more differentiated in between the aggregator space. What are each aggregator's USPs? What can they offer to sellers? So from that point of view, I think there will be some more clarity. I think the aggregator space is also going to provide some interesting developments for everyone by investing a lot in sort of like new areas. So for example, what I found interesting is Thrasio investment in the supply chain in India. So this is definitely something new and could have a long-term impact on just the general seller space. So I think aggregators can, through economies of scale, actually contribute towards the general betterment of the Amazon seller community. Just because, when you have more money, you have more power to influence even Amazon. I am hopeful. And then I think what I think for sellers is really important over the next 3 years and how things are going to change for them. I think it will be much more apparent that owning your customer is really essential. So even if it's just obviously to grow in general outside of Amazon, but also to grow on Amazon, to launch any new product, you really need to own your customers. So in a way, diversifying away from Amazon and getting a better customer acquisition strategy down.
Interesting. Yeah, more of a D2C sort of play to own that entire customer experience. I got a lot of thoughts on that, Matthew, but I'd love to hear yours. What do you think is kind of coming in the next few years for the aggregator space? How will it trickle down?
Yeah, I mean, if you look about 4 or 5 years ago, there wasn't really this M&A market around an e-commerce brand. If you wanted to run an Amazon business, you had to run it for cash flow if you wanted to generate. So, most people, when they come to the end, they try and liquidate the inventory. Maybe they could try sell it for, 2.5x multiple. But now a lot of the sellers that have sold their business, they've got a really strong skill set on Amazon. So we've seen a lot of the people we bought businesses from, they've actually gone back and bought, 1, 2, or 3 brands, and they run in it trying to repeat the same process. So definitely like what Joe said, I mean, there are going to be less aggregators in the market. So I think the aggregators, starting to get a lot more focused. They've seen what works and what doesn't. And you need bigger businesses to get scale. So I think the aggregators are going to sort of push that minimum threshold up, and more of these smaller sellers that have exited, they're going to start buying the smaller brands, and they're going to sort of grow them, bundle them together, and then push it into the aggregators.
That's interesting. Mike, what do you think?
Yeah, I mean, everything moves so fast in this space. So 3 years really seems like a lifetime away. But I think that generally, with the propensity for buyers to demand higher quality, I think that just overall quality of brands is going to increase over time. I mean, you see that with D2C, I think you're going to see more and more like super high quality brands ending up on Amazon as well. And I also think, not that they already exist there, but I think more and more are going to be launching and investing heavily in like a brand on Amazon versus launching potentially just a product on Amazon that makes sense from a keyword perspective. And I think that from like an aggregator perspective, given all the technology and investment and know-how of the space, I bet we start seeing some aggregators begin launching their own brands to try and compete and enter white spaces that they know based on their research exists, but maybe brands that they want to buy or wish they could buy don't necessarily exist in those areas.
Interesting. And Corian, round us out here.
Yeah, absolutely. I would generally agree with what everybody else has shared. I think you'll see a tremendous amount of consolidation as other aggregators continue to struggle to either scale their brands or to raise kind of follow-up rounds to their initial rounds. So I would expect to see, more consolidation next year and in the following year. Sellers are generally pretty smart. And so I think, to Michael's point, they'll start to invest more heavily into brand building, something that, is still relatively new on Amazon, which will, increase the valuations that they can expect when they exit. And I think we'll do that. I also think you'll see, more aggregators start to specialize a little bit more. So I think a lot of us are kind of doing everything. I think we quote that we do 8 different categories. I wouldn't be surprised to see, more that are specifically focused on supplements or, other ones that are focused on specific areas, just because we all can't do everything at the highest level. So you can carve out kind of a niche, being a little bit more specialized there as well. And then ultimately, I think consumers will benefit because you'll have really great kind of world-class micro brands that'll be available not just on Amazon, but direct to consumer. I think more of us will be omni-channel at that point as well. So you'll see stuff in retail, and I think consumers will generally benefit from that.
Interesting. Thank you all. That was, you're right. I mean, 3 years and it's like dog years, I guess, Amazon years, who knows what could happen. I mean, if you'd have looked at this space 3 years ago, it would look very different than it does today. That's for sure. Well, I'm going to hop over to the Q&A here. We've got some questions coming in, and I want to be sure that we get to them. We're rounding out. We got about 10 minutes left here. And I have a couple here that kind of fit together. So feel free to just jump in. One is about IP on a product. So the question is, I own the US and EU patent on my product. Does that patent get sold with the company if you guys buy it, and does it add value to the brand? And maybe in addition to this, so this is relatively specific to a patent, but if anybody would like to add, like, what are some of the other what are some other nice to haves or things that could drive up the value of a brand in your eyes if someone's looking to sell? I'll just open that to the floor.
We would not, it's an easy answer for me. I mean, we would not buy something if we didn't buy the patent, and we also go to see if you have it registered so the patent, the trademark, and in the US as much as in China, for different reasons. In the US for brand registry, in China because so many brands get hijacked, and so now you're paying some sort of a fee to a Chinese owner of that trademark in order to export your own product. So it would be a deal breaker for us if we didn't have both of those.
So patents come with it. Anybody else? What are some other nice to haves? Go ahead, Corin. Sorry.
No, I would say I would generally agree. We would look for the patent and the trademark to not just be in the US, but Europe as well. That's one of our core kind of markets. And I think that's an area that gets overlooked sometimes by founders, whether it's patents or trademarks. I think there is an opportunity for it to be a value add. Like ultimately it depends on kind of what the patent is, how much life is left, and how, kind of the moat that you built around that. But I think it absolutely has an opportunity to be a value add for the multiple. And I think kind of the second part of your question around what are those other types of things, ultimately, like that all gets kind of put into the bucket of defensibility for us. Like, how are you building a moat that make it difficult for other people to kind of encroach on your market share? So, there's instances where, somebody has such a strong review moat that, that in and of itself is defensible for us. And that gets us really excited. Maybe it's a really strong repeat purchase rate. Like I think it can be really great branding that's rare on Amazon. I think it can be different things, but those are all things that we consider value adds when we're looking at a target.
Nice.
Just to add to that, I think like really developed, for example, as I said, like customer acquisition pipeline, and also outside of Amazon, customer engagement. So any paid social channels, anything that essentially there is already a following, there is already engaged customer for us is really, really important.
Yeah, if the seller's got a track record of kicking competitors off with the patterns, it definitely makes the brand more attractive.
That makes sense. Anything that not to skew negative here, but anything that that you see when you're speaking with sellers that can be kind of red flags, or things things that would add complexity, not necessarily kill a deal, but things that sellers could look out for and kind of be aware of, like, hey, this might not help me down the line.
Yeah, there's a few things I'd say that we look for. Obviously, like black hat is one thing that we try and understand as best as possible. A lot of people in the space do it, whether or not it's apparent, but sometimes it is clearly apparent, especially in reviews. If you do like different types of review scraping, depending on when the reviews were posted, you can tell if black hat has been going on or not. We'll also frequently order product to see if it comes with an insert, etc. That's going to be that could be a deal breaker up front. I'd say on top of that, high frequency of lightning deals is definitely a red flag, but not necessarily a deal breaker. The reason why is because your like effective ASP when you're selling is a lot lower, and so that's decreasing your margins. And it also means that your rank is probably declining unless you're lowering price. So that just plays into like price elasticity of your customer and the competition. It just shows that you're facing an uphill battle as a brand without changing something. And then more specific, just because we are health and wellness focused, we have to deal with the FDA on a lot of the products that we sell. So understanding the different claims that are being made for products and different types of regulatory registration, we need to understand, like, if you're doing things that the FDA, it might be low risk, the FDA hasn't, come after you yet, but in the future, let's say they did send you a warning letter, like you're claiming your product does something that you maybe can't. We want to understand what the impact to sales could be if you make a change to those claims. So things on the regulatory side, at least for us, that could impact valuation and could be a deal breaker.
I think from us is really important, and actually very often underestimated, is the quality of the product. So we've seen, like, we have reviewed quite a few brands whereby you can very clearly see that because of aiming to improve margins and profitability, the quality of the product from the start, when the product has been launching, to, like, say, the current date, has continuously steadily decreased. It's very clear where corners have been cut, and it's actually quite easy to see it through like reviews. So I would say, like, this is what you're selling really, and don't fuck it up. So don't cut corners.
I like it. Keeping it real. Anybody else? Any other like things that kind of stick out?
I think just having a pulse on your numbers. I mean, often people come to us and they'll have a expectation of what their business earns, and when you actually recalculate it, it either earns a lot less or a lot more, and that creates difficult discussions when it is a lot less with the seller, when they've got a sort of a number in their head that they're working towards, and if their business doesn't generate that much cash, it becomes a lot harder. So definitely trying to rebuild your P&L on an accrual basis, and understand any adjustments that you want to push. I mean, some sellers just, they want add backs, but they don't really have any support behind it. So to the extent they can get the support to justify what the business makes, it makes the due diligence process a lot easier, and avoids complications down the line.
I have to imagine that's an easier conversation when it works out the other way around.
Yeah, much easier.
Fantastic. Okay. We have a few minutes left. This has been a fantastic conversation. I really appreciate everybody's expertise here. It sounds like the outlook is positive generally, right? Like we're all kind of going through this thing together. Whether you're an individual seller that's just getting started, or you're a brand aggregator, or like Walter, just been selling for a long time. There are ways to kind of shore yourself up and make sure that you come out of whatever we're facing here with a healthier brand and in a better position. Any parting thoughts? Any things that you guys want to make sure that you communicate today? None.
I'll go. For me, I started Goja in 2009, which was like the heart of the recession. And so I guess when you go through a few of those things, you kind of look at what's coming, or maybe what the environment sounds like. And to me, it's there's no, and you look at it over enough time, there's going to be ups and there's going to be downs. And so I'm very optimistic because A, I've gone through that, and two, I'm looking at it over a longer term. And I think if you stick to those fundamentals of profitability and running a good business, no matter what you're doing, you're going to be all right in the long term. So I think we're in a good place as an industry, and I am optimistic, like you said a minute ago.
Awesome. I like that. I like that tone, Walter, to end it on. that optimistic tone as the Hurricane Ian.
No kidding.
Good luck there in Miami. Well, thank you all very much. I think ultimately, if you're an individual seller and you've been watching the aggregator space, it's pretty plain that the money has flooded in, the expertise has flooded in, and now we're starting to see the techniques, the technology, and the advantages start to trickle down to individual sellers. And this group here is largely responsible for a lot of that growth. So thank you all very much. I'm honored to host this, and it was a pleasure.
Thank you.
Thank you, guys. Appreciate it.
Thanks.
All right.
Bye.
Bye-bye, everybody.